What investment property will save you more tax? A house or an apartment? Hey everyone, Tuan Duong, founder of Durotax Quantity Surveyors here for another video designed to help you become a better property investor. One of the dilemmas when it comes to looking to purchase an investment property is always choosing between an apartment or a house. People aren't sure which is the better investment, where the value lies in each property type and how that affects things like tax depreciation, which is what we're going to get into today. Understanding how this works can be a pretty significant decision-making factor when it comes to deciding on what to buy and how this fits into your overall investing strategy. And did you know that over 70% of Australians are missing out on depreciation for their property? That's more than 2/3 of homeowners who could be pocketing thousands of dollars in savings each year. So in this video, I'm going to share with you the differences in tax depreciation claims you can make between a freestanding house and an apartment or unit. But please note that this video should be seen as a guide only and not the sole reason for purchasing property. Make sure you consult with your accountant to figure out what's best for you. All right, let's get into it. Number 1, Division 43 differences. Apartments can generally claim more on capital works, which is Division 43, when compared to houses. So capital works are the structural elements of a building that can't be removed. Now you might be thinking that a house is larger and would be more costly, but this isn't necessarily true. When we survey a property, we use what's called gross floor area, or GFA for short. This is the total amount of covered floor area and measured per square meter. So even though an apartment has a smaller gross floor area, once you factor in common areas like hallways, lift shafts, staircases, and columns in a brand new high floor apartment complex, the tax depreciation claim often ends up being quite similar to a house. Especially when every apartment also needs the same high costing areas to be built, like kitchens and bathrooms. And in some cases, it could mean that you can claim even more on tax depreciation on an apartment than a house, despite a lower gross floor area. Number 2, Division 40 differences. There's plenty of similarities between apartments and houses when it comes to plant and equipment claims, which is called Division 40. These are your non-permanent fixtures and assets like your oven, light shades, and blinds. Where there's a significant difference between apartments and houses is that you can claim common items like the gym, the lifts, and fire extinguishers. Basically anything that's removable from the property. But beware that these aren't necessarily for every apartment. After the changes in legislation in 2017, you'll want to check with a quantity surveyor like us to assess whether your property falls under the eligibility criteria for Division 40 tax depreciation. So with that said, let's show you some side-by-side comparisons with similar properties to see how this works in action. We're going to compare 3 similar types of properties that we had recently surveyed. A brand new 3-bedroom residential freestanding house, a brand new 3-bedroom low-rise apartment, and a brand new 3-bedroom high-rise apartment, each costing around the same price of $700,000. In the first year, we were able to claim $12,584 for the freestanding house, $15,030 for the low-rise apartment, and $16,815 for the high-rise apartment. In the second year, we were able to claim $11,716 for the freestanding house, $13,813 for the low-rise apartment, and $15,255 for the high-rise apartment. In the third year, we were able to claim $10,828 for the freestanding house, $13,111 for the low-rise apartment, and $14,399 for the high-rise apartment. So while there's not a huge difference between each year, once you add up the totals, the differences are pretty significant. That's $35,128 in tax depreciation for the house, $41,954 for the low-rise apartment, and a whopping $46,469 for the high-rise apartment. That's $11,000 more in tax deductions for high-rise apartments than a freestanding house. If you want to see how that potentially translates into money in your pocket, check out our video that explains how to calculate how much tax you can save from tax depreciation. So there you have it. It's clear that apartments, particularly high-rise apartments, will provide you with pretty significant tax savings. But whether or not you're buying a brand new property or an existing one, there's a good chance you'll be able to claim tax depreciation regardless of its age. In our experience, over 65% of the clients who have bought tax depreciation schedules from us own second-hand or existing properties. Now, how much you can claim on tax depreciation shouldn't be the only reason why you buy a property, nor do we recommend this, but it pays to ensure that you're aware of how much you can claim before committing to buying a property. If it's the difference between your property producing positive or negative cash flow. At DuroTax, we provide instant estimates over the phone where we can give you a pretty accurate forecast of how much you can expect to claim before you decide to purchase at no cost to you. If or when you buy the property and you're ready to get yourself a tax depreciation schedule, you can get in touch with us and we'll have your property surveyed and the report completed within 5 business days. Before you go, if you know a friend, colleague or family member looking to buy an apartment or a house and needs to hear this, please make sure you share this video with them. If you got a lot of value out of this video, check out our YouTube channel to subscribe for more. And make sure you click on the bell icon so that you get notified for the next video. I'm Tuan Duong from DuroTax. I'll see you next time.